G'day and welcome to the Firetrail Analyst Series, where we do a deep dive and focus on what matters for a stock or sector in the Australian equity market. Today we have with us Scott Olsson, Firetrail's financials guru, and he's going to be talking about Australian banks. We're going to focus on what matters for the Australian banks over the next 12 to 24 months, the outlook over the medium term for the bank's earnings, dividends and valuation, and then which banks, if any, look attractive in today's market environment. Scotty, thanks for joining us.
No worries.
Let's get into it. Scotty, what matters for the banks over the next 12 to 24 months?
Yeah, well, the next 1 to 2 years, it's really about how the banks negotiate COVID from a capital standpoint. Obviously, the big driver there is bad debt losses. What we've seen already is all of the banks took charges in the most recent reporting season to allow for that deterioration from the virus. There's clearly going to be more charges coming up, and it'll probably be pretty lumpy because at the moment you've got all this stimulus in the system. Experience is probably good at the moment, but as that rolls off, we're going to see more bad debts coming down the line. It's very hard to pick where that's going to land. The way we're kind of thinking about it is relative to the GFC, and we think in areas like SME, credit cards, you're going to have losses that are worse than we saw in the GFC, whereas areas like institutional lending, it's probably in a bit of a better position, so we're expecting that to be a bit better. Overall, the next 3 years, we're kind of looking at about $50 billion of bad debt losses across the four major banks. Relative to the profits they're making on a pre-provision basis, that's about 40% of pre-provision profits. So it's a big hit to P&Ls and dividends. We've already kind of seen that playing out with a few dividend suspensions and NAB, a really low dividend. But the important thing is where capital gets to. And under that scenario, the capital ratios only really fall into kind of the high 9% range. And that's well above minimums and not that far off APRA's unquestionably strong 10.5% benchmark.
Okay.
Within that, NAB and CBA are the strongest. NAB, raised over $4 billion of capital just a couple of months ago, so that's helped them there. ANZ and Westpac are the ones that are in that high nines range, but we think they can kind of get back to those comfortable capital levels on a 3-year view, just with dividend cuts and some other action rather than big dilutive capital raising. So from a capital standpoint, they're actually in a reasonably good position this time around.
So when you're thinking about the banks, then you're obviously navigating the short term and the medium term. The medium term outlook for the banks in terms of their dividends that you mentioned before, the valuation, the outlook for their earnings, how are you thinking about that right now?
Yeah, so when we look at kind of FY 22, 23, that's kind of the period where we think bad debts might be getting back to closer to mid-cycle type levels. And that will drive an earnings recovery, obviously, just from lower bad debts. So then you're looking at what the core operations of the banks are doing. And at that time, they're probably still going to be facing the pressures that we saw them facing before COVID hit. And that is, low interest rates, pressuring margins, pressure on the fee income line, and a lot of regulatory compliance cost, which just makes it harder to lower the absolute cost base of these banks. You kind of have to pull out costs just to stand still. So they're all headwinds still. I think one of the positives that could come out is on a flight to quality that we're starting to see. So basically since the GFC, we've seen the flow of mortgages going to the majors just steadily decline over time, and guys like Macquarie and the offshore lenders are picking up share. We've started to see some data since COVID kind of hit that suggests that a lot of mortgage share is going back towards the majors.
Right.
So it's a short-term thematic at the moment, but that could actually support a bit of share stabilisation for the major banks in total. And what we saw through the GFC, that flight to quality was a positive thematic. Despite that, we still think the earnings bases in 22 are probably 10 to 15% lower than they were in FY19. So at that level, you're kind of getting ROEs of 8-9% for ANZ, NAB, Westpac, maybe closer to 10 for CBA. That's down from low to mid-teens only a couple of years ago. So that's sounding pretty bearish. I guess the positive spin on it is even at that level, if you're paying out 70% of your profit, the dividend yield is going to be 6.5%. Again, for ANZ, NAB, Westpac, CBA closer to 5%. So it's a reasonable yield, but you have to get through 20 and 21 where dividends are going to be well below that level before you're getting, a 5% plus yield.
So at that sort of yield, and I sort of framing it up like that, are the banks a buy or?
No, not in our view.
Okay.
I think they don't look expensive anymore. That 8 or 9% ROE, it's obviously come down a lot, but you're paying a discount to book for all the banks except CBA at the moment. So that probably makes sense. I guess where they would be a buy is if the environment is a lot better than what we're thinking and maybe bad debts are a lot lower. But in that scenario where the banks are performing well, we think other sectors and other stocks are going to be performing even better perhaps. And so our kind of thinking in the portfolio is we're allocating more capital towards those opportunities rather than towards the banks at the moment.
Yeah, that makes sense. So which banks, if any, would be a buy in your view, Scotty?
I've got two to mention. So NAB is our preferred of the majors. We really like Phil Cronican and Ross McEwen as the chair and CEO combination, bring a real lot of experience, which you want going through a crisis like this. Obviously, NAB is very overweight SME, so I think they will have higher bad debt losses than the other banks, but they've now got the capital position to deal with it. So I think that is the key thing there, and that SME franchise is still a very valuable franchise. The new CEO, I think he's going to bring a lot of accountability to the business, pull out a lot of unnecessary costs, and when you're looking kind of medium term, I think there's an opportunity for him to improve the retail franchise. So we like the NAB story. Another one that we like, which actually isn't operating in Australia, is Virgin Money UK. Now, I guess you can say the same things about the UK market. It's a very tough banking market. Globally, banking is very tough. And Virgin is the 6th largest bank in the UK. So you could say they're in a bad competitive position as well, similar to the regionals here. So there's a lot of negative points you can make. Our thinking on that one, though, is that the acquisition and rebrand to Virgin Money a couple of years ago gives them a lot of levers they can pull. We think there's a lot of opportunities on the asset and the liability side of the balance sheet, and also a big cost out opportunity. And management has shown that they are good at executing cost out. That business, when we look out to 22, 23, we think can be delivering close to a double-digit return on its tangible equity base, and it's trading at 0.35 times that tangible equity base at the moment. So,
wow.
So it's really priced for capital destruction, and similar to the Aussie banks, we see capital levels falling but not getting anywhere near minimum levels and not to levels where they need to undertake a very dilutory capital raising. So yeah, they're kind of the two in the space that we like at the moment.
Great. Well, Scotty, thanks so much for your time today to talk about the banks. It's obviously a big part of investors' portfolios. So really interesting to run through that with you today. And thank you for joining us for the Firetrail Analyst Series.